One of the most widely followed versions of the yield curve has just done something extremely rare. It's done what's called an uninversion. Throughout history, these uninversions have been flawless recession signals. Every time that this happens, something is going on in the US economy that makes a recession almost inevitable in the months that follow. All of these gray bars that you see here mark the periods identified by the NBER as being official recessions. The last four, including the Great Financial Crisis, were preceded by a yield curve uninversion. We also saw this in the lead up to the recessions that occurred in the 1970s, and we can even rewind to 1928, right at the very start of the Great Depression. The yield curve uninverted in October of 1929. Yes, the yield curve uninversion even worked as a recession signal 100 years ago. Now, there is something quite special about today's uninversion that makes it very different to the others, and could bring into question how efficient it is at being a recession signal this time around. But as we know, the most dangerous words in investing are "this time is different." But first, I want to wish you all a happy new year. Thank you all for following our work. We wouldn't be here without you. We truly appreciate every single one of you. And Bravos Research would not be here in 2025 if it wasn't for you. To celebrate, we're doing a discount for this first week of the new year in order to allow a maximum number of people to access our trading subscription. So make sure that you are taking advantage of this. We give you our buy and sell alerts on all of our trades and take you through everything that we know about financial markets. We've had an incredible number of highly successful trades throughout 2024, and we're going to do everything to make sure the same thing happens in 2025. If we take each moment where the yield curve uninverted like today, and we look at what happened to the US stock market following those instances, in the vast majority of cases, this was not a great development for US stocks. Many of these occurred right before or right at the beginning of major bear markets, including at the very peak of the 1929 market before an 80% crash in US stocks, right at the peak of the dot-com bubble before a 50% crash in stocks, and right at the peak of 2008 or right before a 60% crash in stocks. Of course, like any indicator, there are exceptions. 1979 right here is a great example where the stock market actually continued to move higher, but as you can see, even in that episode, the economy did not escape a recession. Ever since the start of 2023, people have been talking about the fact that the yield curve is predicting a recession. Of course, we haven't seen one materialize yet, and the stock market has been thriving. Anybody that's been paying too much attention to the yield curve over the last couple of years has been missing one of the strongest stock market rallies in history. But the question now is, after 2 years of the yield curve being inverted, is the uninversion that we're seeing today signaling that a recession is finally ready to start, and should it be making us flip to bearish on the stock market? Now, something to keep in mind is that this version of the yield curve is definitely not the only one. There are countless different types of yield curves, each one that is using a different maturity of government treasury bonds. And many of these actually already uninverted back in July of 2024. This particular one that we're looking at today is a little bit late to the party, but that definitely doesn't make it less important. This yield curve is what's called the 10-year minus 3-month yield curve, which is basically the maturities of the bonds that make it up. The way the yield curve works is basically you take the yield of a government bond with a long-term maturity and subtract the yield of a government bond with a short-term maturity. And then you look at that number every day over a long period of time, and you get what looks like a yield curve. And the yield curve that is composed of the 10-year yield and the 3-month yield is a very widely followed version of it, and there's actually a pretty good reason for this. The 3-month is basically the yield that tracks what the Federal Reserve, the US central bank, is doing with their interest rate. The Fed basically controls the 3-month yield as they like. They can move it up and down as they wish. And so naturally, if investors are interested in knowing what the Federal Reserve is doing, they should be paying attention to the 3-month yield. The 10-year yield, on the other hand, is not controlled by the Federal Reserve. It's really the market, private investors, that dictates where the 10-year yield is going. And the reason that it's so widely followed is because it's considered to be a great indication of something called the neutral rate. At least that's what numerous pieces of academic research suggest. The neutral rate is one of the most important concepts in economics. This is supposed to be the ideal interest rate for the economy that is not too high or not too low. So in other words, when the Federal Reserve's interest rate is below the neutral rate, it means that the economy is being stimulated simulated that monetary policy is what's called loose. If the Federal Reserve suddenly raises their short-term interest rate above the neutral rate, that means they are tightening and so slowing the economy down. And this is why the yield curve works so well as a recession indicator, because when this happens, the yield curve is inverted, and so the Fed is slowing the economy down and basically sowing the seeds for a recession to occur. When they begin to lower interest rates again, that's usually because the economy is slowing down significantly and heading into a recession. And that is when the yield curve uninverts. Now, if we jump out of the theory a little bit and take a look at the 10-year yield, which can also be considered as the neutral rate, and we add the 3-month yield on top, we see that since the beginning of 2023, the yield curve has been inverted, just like it was right before the last 3 recessions. And we can also now see that the yield curve has actually just uninverted. Again, just like it did right before the last 3 recessions. But as I mentioned at the beginning of this video, there is something quite different about today's yield curve uninversion. And that is that the 10-year yield has actually been rising over the last couple of months. As you can see, that is substantially different from the lead up to the last 3 recessions. In all of those instances, the 10-year yield was moving aggressively lower, not higher like today. And this is exactly what you would expect. Because when we plot the 10-year yield against a chart of GDP growth in the United States, so basically a line showing us how much the economy is growing each year, we see there is a very tight correlation between the two. And so it's only natural that when GDP growth is declining, that you would see the 10-year yield declining at the same time. The fact that the 10-year yield has been rising over the last couple of months is actually telling us that the bond market is not worried about a recession happening right now. So what does this all mean? Does that mean that we should be completely ignoring this yield curve uninversion? Probably not, because when we add the United States unemployment rate on top of the yield curve, we see that there isn't really much evidence today to suggest that we aren't towards the end of the business cycle. So far, the unemployment rate has curled up and began to move higher. It's very possible that if the yield curve continues to steepen, the unemployment rate will continue to move higher and potentially trigger an economic recession. However, the fact that bond yields have been moving higher during today's yield curve uninversion could be telling us that we still have a little bit of time before this next recession actually begins. As a result, we are officially extending our timeline for a recession in this video. With bond yields coming back towards 5% today, it tells us that higher growth and economic resilience are being priced in by financial markets. Now, what does this all mean for the stock market? As you may have seen in the last couple of episodes, spikes in bond yields aren't such a great thing for the stock market that has typically seen some corrections in these kinds of environments, which could lead to some short-term volatility in markets today. But in general, with a recession once again being delayed, it seems like any market volatility right now could be an attractive opportunity to buy the dip on markets. Although we are hedged against short-term volatility, the active trades that we have on our website are still net long on the stock market. If you're interested in following all of our trades step by step and our thought process on markets and our entire trading strategy, make sure not to miss the discount that we're doing for this new year and kick off your trading year in 2025 to a great start with us.